Thank you, members, for joining. Please let's allow it 1 more minute to allow others to join as well, and then we can kick this off. So, good morning, members, once again. I want to take this opportunity to welcome you to this session today, and thank you for taking time to join us for this timely conversation. My name is Derek Vikiru. I lead membership and partnerships here at the American Chamber of Commerce. And before we start, I'd just like to give a run of show and what we expect in this session today. So in this session, we'll be looking at, or rather unpacking the significant economic presence tax regulations. And we will receive a technical presentation from Frederick Kimotho. He's an associate director at Deloitte and also the chair of the AmCham Tax Task Force. That will set center stage for a panel discussion discussing the technical and business perspectives, and it will be followed by a question and answer session. And these will be taken by our panelists. So we have panelists Nixon Omondi, who is the manager, digital economy and tax office at the Kenya Revenue Authority, alongside Kenneth Njuguna, who's a tax partner at Anjarwala and Kana. And Fred Kimotho will also be part of that panel, associate director at Deloitte. This session will be moderated by Michael Wachinga, who's a senior manager for tax at PwC. And then after that, we'll go into a Q&A session, time allowing. However, we're looking to put this session, to keep this session within 1 hour. So I'm here representing our CEO, Maxwell Okello, and I'd like to give remarks on behalf of AmCham. So once again, ladies and gentlemen, thank you for joining this timely conversation. On behalf of the American Chamber of Commerce, I'm delighted to welcome you today to this expert briefing, reviewing the draft significant economic presence tax regulations for 2025. Thank you for taking time to join us, and we hope this is going to be an insightful and timely conversation. So the introduction of these regulations, they represent a pivotal moment for Kenya's tax landscape, particularly as it relates to the digital and the cross-border economy. These regulations are part of the broader global debate on how to fairly allocate taxing rights in an increasingly digital world. They will directly affect many of our members, especially those operating in technology, financial services, consulting, and consumer markets. As businesses, we recognize both the importance of governments mobilizing revenue and the need for predictable, fair, and investment-friendly policies. Striking this balance is critical for Kenya's competitiveness as an investment destination. That's why today's dialogue is so important. And through this session, we aim to unpack the scope and the intent of the SEPT regulations, to clarify compliance requirements and the practical implications for businesses, to explore the linkages between Kenya's approach and international tax developments, including the OECD and G20 BEP's discussions. Most importantly, we want to provide a platform for member feedback to shape our advocacy efforts with government. I would like to extend our sincere appreciation to our distinguished speakers today. So Nixon Amondi, once again, Kenneth Juguna, Frederick, and of course, our moderator, Michael Wachinga. Your expertise will help us navigate both the technical and business perspectives of these regulations. I encourage all participants to engage actively in these discussions, ask questions, and share your perspective. So please, if you have any questions, use the Q&A box, and we will try and respond to those as many as possible. The insights from today will be critical in shaping the submissions we prepare for the ongoing public participation process. Once again, thank you for joining us. I look forward to a rich exchange. And with that, I would like to invite our first presenter, who's also the chair of the AmCham Tax Digital Task Force, Mr. Fred Kimotho, to take us through the technical presentation and can also make remarks on behalf of the task force. Welcome, Fred.
Very well. Derek, please confirm that you can hear me.
We can hear you, Fred, and we can see your presentation.
Very well.
We'd also put your video on for the panelists.
Very well. Thank you very much, Derek, for that introduction. We do appreciate the opportunity to come and present to the members this particular conversation. So as Derek put it, my name is Fred Kimotho. I work with the Deloitte East Africa full-time, looking after tax policy and tax controversy. And I do chair the task force, for American Chambers of Commerce from a tax perspective. What we do at the task force is basically to do what we're doing today, for example, in terms of members' education. But most importantly, we try as much as possible to ensure that we are on the table in terms of shaping the tax policy. And we do appreciate your support. Over the years, we have gotten your input, be it in the finance bill that we have on an annual basis, be it the tax laws amendment that we have had, or any other ad hoc bill, or regulations like the ones we're actually discussing today. So we request you to continue giving us your input, and as such, we should be able to see some of the fruits of these particular conversations. So without much further ado, I think I'll go straight into the technical conversation. So basically what we'll be focusing on today is SEPT regulations, or what we call significant economic presence tax regulations that were published, I think sometimes in September. And this was in line with the power that conferred on the commissioner by Section 12E of the Income Tax Act, where the commissioner is then expected to publish some regulations for them to be more practical, to provide the administrative oversight in terms of how it should be done. So today we are basically going to focus on that. As Derek put it, we have a good panel that will also be able to address some of the questions that you have been seeing. So for me, it's basically just to set the pace. So straight into it. So digital taxation of the digital economy has been quite, a contemporary subject, not only in Kenya, but across the globe. So in Kenya, it was introduced sometimes in 2020, the Finance Act of 2019. And that is when we saw also VAT on digital marketplace being introduced. But however, in 2019, I think it was just more or less a definition of some of the terms that are used in the digital economy. But the tax came into force in form of what we call digital service tax in January 2021. And then the commissioner issued the regulations very, very fast because the regulations were actually published on the second day of January in 2021. So the rate then was 1.5% on the gross transaction value. It was being charged on both resident persons and non-resident persons. Of course, the fact that it was being charged on both resident and persons and non-resident, it got a bit of hue and cry across the tax fraternity. And as a result of that, basically based on the submissions that also American Chambers of Commerce did, the policymakers deemed it fit to drop resident persons from the ambit of digital service tax. And as such, digital service tax then only became effective on non-resident person, and that provision became effective on 1st of July of 2021. So the rate then was increased from the 1.5% to 3%, basically doubling it. We did have a lot of activity in the Finance Act of 2022, but I remember there was an attempt to increase the DST rate again. However, from a public participation, that proposal was actually dropped until 2021, when 2024, when now we saw the overhaul, or rather the repeal of digital service tax, and it was replaced with now what we call the SEPT, or the significant economic tax. So basically, the difference between the DST and the SEPT, I normally say, is just maybe number one in terms of the name that it is given. Number two, of course, which I think is the most critical one, and it was also probably responding to some of the global conversations that are happening, is the base. Because remember that digital service tax was on gross turnover. So what SEPT is basically doing is to charge it on what we call deemed profits. So you are an entity outside Kenya, you are making $100,000 per month. So the provision then deems that your profit out of the 100,000 is $10,000. And then, of course, we apply the tax rate of 30%. But effectively, you come back to the same thing. You have SEPT then at the effective tax rate of 3%. So basically, that was the main change that did happen there. And I do believe that that was just to try and catch up with some of the conversations that are happening at global level. But with all intents and purpose, I would say we still have DST, but given a different name. There was a proposal to increase the rate to 6%, but that was also not adopted. The which had even been dropped even before the finance bill of 2024 was withdrawn in its entirety back in the day. So basically, from this side alone, you can see it has been quite a bit of activity as far as taxation of the digital economy is concerned from an income tax perspective. You can actually see almost every year there has been a mention of this particular tax. So the question is whether maybe we'll have a bit of stability as we go along, and we hope there will be a bit of stability, but we also do appreciate that it is a new concept. So there's a lot of experimenting that is also happening. But we hope that we'll give it a bit of time now for the taxpayers to be able to predict. Of course, then what is happening that in September, that is last month, the government did release a draft regulations, which is the subject of the conversation today. So from a scope perspective, again, and I think we have already mentioned this, so we are saying that this tax SEPT is only applicable to non-resident persons without PEs in Kenya, or rather without a permanent establishment. And it applies to when you're providing services to Kenyan users over the internet or electronic network. So we look at the scope in terms of what are the services that are covered within this particular tax, and those ones are very well expounded at the regulation number 4, or paragraph 4 of the regulations, and we'll be closely looking at that in a short while. From a mechanism perspective, it is one of those taxes that is self-assessment regime. So the non-resident person is expected to self-assess. You know, to say, for example, I've made sales of this amount in Kenya, and then they deem profitability of 10%, and then they apply 30% on that level of profitability. It is a monthly obligation, and we hope the policymakers are not thinking about making it one of those taxes that is after every few working days, as you have seen the trend on some of the other taxes like withholding tax. But for now, it is a monthly tax. We do account for it after the 20th day of the following month. So the nature of it, as I mentioned earlier, it's more or less an income tax. The good thing also is it's a final tax in nature. What that means is that once an unresident pays that 30% of the 10% deemed profits, then they do not have any further obligation in terms of even declaring that one in a way of a return or even paying any further tax from it. And also, one of the key things to note, and we'll be looking at this, is that the tax may be as well be exempted under the double tax agreements that Kenya has signed with a number of countries. Now, how do you determine that a user is located in Kenya for purposes of this particular tax? So the regulations do provide a criteria, and there are basically 4 points. Number one is on the terminal, where the user accesses the digital interface, digital communication or electronic device that is located in Kenya. Then that service is then deemed to have been, the income from such a person is deemed to have been derived or accrued in Kenya. The other one is, of course, the internet protocol, where we are saying the internet protocol address is registered in Kenya, or an international mobile phone country code that is assigned to Kenya. So that person also, then the income that you make from the person, if you're a non-resident, then it is expected that you do declare it for purposes of SEPT. The other one is where the payment, which is the most obvious one, where the payment is made from Kenya. So basically, we are saying there's a payment that has been made from Kenya using a credit or debit card, from a financial institution that is located in Kenya. Of course, some of these may appear very straightforward, but sometimes they can bring a bit of complexities or ambiguities, so to say, because you can imagine sometimes a scenario where you are using a credit card in Kenya, but for example, you are consuming a service while outside the country for some reason. So they may appear very straightforward, but sometimes there's a bit of nuances to it, which then may require a bit of consultations with your tax advisors or even with the revenue authority by way of private ruling. And of course, the last one is the address of the user, where the user's address is Kenya, be it from a business perspective or residential. Then that user then will activate set for the non-resident person. So that's also critical to check. So just basically just four points in terms of the user location for purposes of you determining whether you're eligible to pay SEPT in Kenya or not. And it is good for us to ensure that we do check that. Of course, most of the non-resident persons will use this criteria to set parameters in their system to ensure that they are able to see, or rather to separate the income that they are deriving from or accruing in Kenya from the income that they are deriving or accruing from other parts of the world. And we have seen this criteria work quite well. So from a services perspective, and I think now this one is quite critical. If you had looked at the DST regulations, then you'll actually notice that, and we have looked at the SEPT regulations, you'll actually notice that they are more or less speaking to each other. However, you can see that the policymaker in this case, I think, working very closely, of course, with the revenue authority, they're trying to sneak in quite a number of other new items in there. Of course, it's in a bid to ensure that the tax, the revenue is expanded. But in terms of the baskets, if you look at it, the target or the service that will be covered are basically digital and online content. You have apps, you're selling apps, you're selling ebooks, you're selling films, or some media, or you're streaming, you have some streaming platform from outside Kenya, then you'd be expected to account for SEPT. There's also what we call software and cloud services, software programs, cloud computing, data management, search engines, and things like AI-driven services. And basically, I think there's even a paragraph that specifically speaks to artificial intelligent services. So that's also one of those that is being captured. As I said again, this topic is sometimes it may appear very straightforward, but sometimes it's quite complicated. Speaking on cloud services alone, and we have done a bit of research with our team here at Deloitte on cloud services, and their clients who are quite big on some of this. You'd actually put it in quite a number of baskets. You'd have things like software as a service, you'd have things like platform as a service, infrastructure as a service. And all those three, you may arrive at the conclusion that actually one of them or two of them are not subject to SEPT, but they're subject to maybe withholding tax, for example. So there's a bit of complexity that are in there. So which is then there's need then to look at your contract, be very clear that you are covered under this tax and not under the other one. The other services that are covered also are online platforms and marketplaces. And these are things like e-learning, e-ticketing, and those kind of services provided by non-resident. And of course, the last basket is financial and data services. And we'll be speaking about this a bit more. You have online payment facilitation. We also have digital asset exchanges, and it was interesting to see digital asset transactions in here, given that the Finance Act of 2025 just repealed digital asset tax, which was actually imposing tax at 3% of the transaction value. So we'll be probably also be asking the question, what is this exactly, are going to achieve? Are we also trying to take away and, take back something? And the reason I say that, while I do agree that the digital asset transactions in this case, as envisaged accept, are not have necessarily the same tax base as it were at the digital asset tax. You'll actually notice that the same Finance Act of 2025 did introduce excess duty on fees charged by virtual asset providers, and it is at the rate of 10%, I think. So if you look at that, and you also now look at this same transaction being captured under SEPT, while I agree that one of them is indirect tax and the other one is direct taxes, there could be a concern that we are still going after this category of income quite a bit and heavily. And as we said, being a nascent or a very young economy, it would be good maybe to give them a bit of time to grow and see how we can expand the tax base as we go along. But as it is now, of course, there's that issue of it being seen like we actually targeting quite a bit from the same person. Although for excess duty, of course, it is the consumer who bears the tax. But of course, it does inform the transaction fee that you would charge. Key to note is that there is also some sort of exemption from SEPT. And basically, there are three of them. I think before the Finance Act of 2025, or is it the Tax Laws Amendment Act? There was an additional one on the threshold, but for now we have three exemptions. One of them is where you're providing services through a permanent establishment in Kenya. And the reason, of course, there's an exemption on that is because you would then be expected as a non-resident to declare your income in Kenya and pay tax at the rate of 30% on your profits. So as a result, you are excluded from SEPT. Number two is people who are chargeable under Section 9(2) of the Income Tax Act. And basically, this one would cover people who are in the transition of messages and such like services. And of course, people who are also subject to tax under Section 10. And I think also in abundance of clarity, then it would be good to mention that this is also for Section 35. Basically, people who are subject to withholding tax. If your income is subject to withholding tax in Kenya, so SEPT is not one of those taxes that you should worry about for obvious reasons. So remember, SEPT also targets the gross, or rather your income, as per se. So the moment then withholding tax is applied at the rate of 20%, the government has already made their income. So subjecting it further to tax by way of SEPT then would be tantamount to double taxation. I believe that is the reason why if you're subject to withholding tax, then SEPT would not be applicable, which is quite critical. And the other one, of course, is services to an airline, in which the government of Kenya has at least 45% shareholding. So if you're providing services to an airline in Kenya, and the government has 45% shareholding, which I believe is one would probably just be Kenya Airways. So if you're an non-resident person, you're providing services to Kenya Airways, then SEPT will not be applicable on you. Of course, this one can be led in varied ways. You could, for example, be providing services to Kenya Airways and many other people in Kenya. So the question is whether the income that is exempt from this particular tax is only the income that relates to Kenya Airways, or it includes the rest of the incomes. And of course, that can be debated. But as it is now, I do believe that to the extent that you are providing any service to the Kenya Airways, then SEPT would not be applicable on you, whether or not you're providing to other people. So one of the key things that we have always received in terms of people analyzing whether they are eligible to SEPT or not is, where do you start? So, and one of the things that you need to note is that the starting point should always be the exemption list. So first of all, for example, you look at your service. Say, for example, you are providing software as a service in Kenya. So you first of all ask yourself, is that service subject to withholding tax or not? It is only after responding to that question that you can now go to SEPT. And if the answer is yes, then SEPT is a non-issue to you. But if the answer is no, then you go and test whether SEPT would be applicable on your income. And there are instances, of course, where you may not be under you may not be under any of the two regimes. But the key critical thing is to say you have to start from the exemption list first of all, before then you go to the analysis from a SEPT perspective, and that is quite critical. So once you have done that, I think we can then briefly talk about registration of SEPT and compliance. I think one of the things that we have to commend the Revenue Authority for is the way of registration. They have really simplified the process. The team is quite responsive, and I'm not saying that because my good friend Nixon is in the call, but I mean, most of you who have been talking to that office will agree that the responsiveness in terms of registration of new taxpayers, the support in terms of new information has been tremendous. And I think we should encourage that across all the arms of the Revenue Authority. So simplified registration is what you're required to do if you're non-resident. That process, I can confirm, it takes less than a week if you have provided all the information. And it is quite a straightforward one. After which then you're issued with a PIN, and that PIN is supposed then to facilitate you in terms of making payments. So should you, for one reason or the other, being an non-resident, think that you do not want to register for this particular tax, you can appoint a tax rep who can do it on your behalf. And I think that one is also working quite well. I think we did talk about the filing dates, of the 20th day. But you're also required to keep the records in line with the provisions of the Tax Procedures Act, more specifically Section 23. Then you need to ensure that your records are proper. From an enforcement perspective, it more or less aligns with the other enforcement measures for any other tax in Kenya. And the critical one is just to know that if you don't pay SEPT in good time, then there will be penalty of 5%, and there will be interest of 1% per month to the extent that there's an amount that remains unpayable. And of course, recently we saw the introduction of some powers to the commissioner for them to be able to issue agency notices for people who are not compliant. So there will be a question on whether the legally you're able to issue an agency notice to an entity that is outside Kenya. But of course, if you are a non-resident person and you are being paid through, for example, a Kenyan bank, and you have not been complying with this particular tax, be sure that the commissioner then can invoke their powers and issue an agency notice against you. So I think the last one for me, from a SEPT regulations perspective, is maybe just to put the lenses and ask ourselves what are some of the strengths that we have seen on these particular regulations, and as well what are some of the weaknesses that we think can be addressed as we go along. And as I said, the good news is that these regulations are in draft form, so we still have an opportunity to put in our views, after which then they'll become final. I think some of the points that we'll be mentioning are the ones that I will do mention here. So as I said earlier, from a legislation perspective, it has been seamless. It has been very good, very supportive. So registration is quite good, which is a big strength. Of course, also from the transition, this SEPT became effective, I think, on 27th of December of 2024, sorry to say. And I think what happened then, people who are under the DST regime were moved seamlessly to SEPT from an administrative perspective. I think the only critique that we may have is the tax became effective on 27th of December, but we are still discussing the regulations now. I think that is almost over 9 months after that particular date. So there'll even be a question of whether legally the revenue authority actually can go after someone who have not complied with SEPT on the simple reason that while the commissioner was empowered to issue regulation under Section 12E of the Income Tax Act, they did do it in good time. And as a result, there has been a bit of confusion in terms of what is actually subject, what is within the scope. Although the primary registration does provide for some of these details, we do believe that proper implementation should have come together with the regulations. So in the absence of that, then there is that legal question in terms of actually whether the commissioner can go after anyone who has not complied with this tax to the extent that the final regulations have not been gazetted. So I think it would be good then to also maybe think about that but from an administrative perspective, and that's why I put that in brackets. I think there has been a bit of support from the Revenue Authority to ensure that the transition is more or less seamless. And I think, of course, regulations, if you go through them, they do provide quite a bit of clarity on some of the things. And most importantly, also, the risks under regulation or paragraph number 4 of those regulations does then provide a bit of clarity in terms of the specific services that are within the scope. What are some of the weaknesses or some of the things that you think we should think about, even from a policy perspective? I think recently, just between last year and this year, we have seen quite a number of changes in this particular sector or attempts to tackle this particular sector, rather the digital economy. I did start with saying that there was an excess duty that was introduced last year under the Finance Act of 20, is it actually this year? Under the Finance Act of 2025, where we have now, it's actually this year, 31st of July of 2025. There's a duty on digital assets, on transaction fee that is charged by virtual asset providers. So there's a duty that is introduced there. There's also the expansion of the definition of the term loyalty under the Tax Laws Amendment Act, which became effective on 27th of December. And actually, that expansion of that definition technically puts almost all the payments in relation to rights to use the software within the ambit of withholding tax. What then that means is that then the conversion of SEPT does not arise. But as I say, there's a very thin line between, for example, software as a service, whether it is subject to withholding tax or it is subject to SEPT. So it's a lot of ambiguities, and I think as Deloitte as well, we have really engaged the Revenue Authority on this. I think I've gotten a few private rulings, which obviously then point to the sense that there could be a bit of confusion. And of course, there's also withholding tax that was introduced on the owners or the operators of digital marketplace, when they are paying both residents and non-resident for some of the digital services that are provided. So that alone actually does then go back to eating into some sort of scope. I would actually say, for lack of a better word, there's already an overlap between SEPT and with this withholding tax that was introduced recently in terms of what would be applicable. And some of these efforts, you'll actually notice that while they are very good efforts, they seem to be bringing a bit of confusion in terms of what is our policy direction as a country. But also, most importantly, it brings a lot of ambiguities in terms of what to apply where. Because we have had instances where, for example, an unresident person is applying a service to Kenya. So the Kenyan person, because withholding tax is an obligation for a person paying, they are very hesitant not to withhold tax. So they end up, for example, withholding. But then on the other side, an unresident person, based on the analysis, they think that that is subject to SEPT. So you then have suppliers and purchasers of services being at loggerheads, because remember, by withholding, it doesn't exempt you from doing the SEPT. So there's a bit of things that we need to align there, and maybe some notes and public rulings from the Revenue Authority would really help. Of course, there's a question of the SEPT and the double tax agreement that we have with Kenya, and I think we'll be addressing that during the panel conversation. And one of the things that I also think that we missed out, and I really don't know why we dropped it, is the ability to have what you call a threshold, so that then we can exempt people for economics. And tax, the canons of taxation require that there's also a bit of economics in correction of tax. For example, you can't be engaging a consultant just to correct for you and limit for you 2,000 shillings to the Revenue Authority. So there's then need for some threshold. I think basically there are three types of thresholds. We could have revenue-based thresholds, which Kenya had actually introduced. We have the 5 million Kenya shillings, and I think Nigeria also adopts that. We could have what we call transaction, user-based thresholds, and also activity-based thresholds. So some of the countries like India actually use a hybrid. So you have both the transaction, or rather the user-based threshold, and also the revenue base. And that, I think, would then tick the box from the canon of taxation in terms of what is expected. So I think, team, without further ado, and thanks to the team that helped me in putting this together, that's Maurice and Moses, who I think are in the call. I think I'll hand over the mic to our moderator, that is Michael, I think, from PwC, to take it from there. Michael, over to you.
Thank you, Fred, and confirm you can hear me.
Yes, you can hear loud and clear.
Great. Thank you, Fred, for the good presentation. I think you have raised some of the questions that we have been getting from taxpayers. Allow me to introduce the other panelist. We will be joined by Nixon Omondi, who is the manager of the digital tax economy at the Revenue Authority, as well as we will be joined by Ken Chuguna, who is a tax partner at Anjawala. And allow me to start off with you, Nixon. Yeah, and Fred has raised a very good question about the legality of enforcing SEPT, noting that the Tax Laws Amendment Act introduced SEPT in December 2024, but we are here discussing the regulation 9 months down the line. Is it good to assume that KRA then will lack the legality to enforce and correct SEPT from December to date?
Thank you, and good morning, Michael. Thanks a lot, Fred. Very well laid out presentation. But again, receive a lot of greetings from my Commissioner General, Commissioner Acting, and also the Head of Policy, Mr. Morris, who of course okayed that we can participate in this as KRA. And I'm also happy to mention that I'm joined by my very many colleagues who are listening in, picking up issues that Fred is raising and those that the people in this forum will raise, so that then we can address them in the best way possible. Very quickly, Mike, on the issue of legality. When you look at what Section 12E mentions, is that the CS may develop regulations for the proper operationalization of SEPT. So it's not shall. I know it's a lingua in terms of our constitution. It says it may. So that means that the law in itself seems sufficient. However, it is the CS has deemed it fit to elaborate on what the law has provided so that our taxpayers can be guided much better. So there's no problem with the law as it is. And we agreed, we transitioned all the taxpayers seamlessly from DST to SEP by dint of the dictates of the law. But the regulations are there now to guide, and I'm happy Fred has mentioned the various sections of the regulations, or the paragraphs, that will assist taxpayers to understand SEPT and also facilitate their compliance so that it's as smooth as possible. Thank you.
Yeah, thank you, Nixon. And in terms of may and shall, allow me to loop in Ken to comment. And as you comment on that as well, Ken, I know you have looked at the draft regulation, and from a broader understanding of the SEPT regime, are there any notable gaps in the current framework, and how may that then cause uncertainty in terms of compliance for multinational enterprises?
Thank you, Michael, and good morning, everyone. So look, broadly, these are good moves. The regulations are a welcome move. We've seen some very notable improvements. If you look at there is a provision which says on how you compute SEPT, on what value you're supposed to compute SEPT, which is designed to provide clarity and so on. So you've seen some notable improvements, but at the same time, and that's why I believe we do have this stakeholder engagement. There are various areas which probably need to be looked at a bit more. And I'd say the first one is around the scope. So there's a whole list of around 15 services on which SEPT is supposed to apply. And then at the very end, there is a very broad catch-all provision. And whereas we appreciate why it will be there, what we ideally only want is a situation where it introduces ambiguity, because the commissioner then says that this particular service, even though it is not in the list, ought to be subject to SEPT. So in that case, all we'll be recommending will be just a slight adjustment to the wording to then say that it is any service which is broadly similar to those listed above, so that narrows down to what can be to be included as a service subject to SEPT, even though not expressly listed in the list that is set out there. We've also seen quite a focus on enforcement, even though there were broad enforcement powers under the Tax Procedures Act that currently exist. We've seen the introduction of a provision in the regulations, which is designed to allow the commissioner to appoint businesses and payment processors in Kenya as withholding agents. And of course, whereas we do see where that is coming from, all we probably want to ask for in that regard is around a bit more tightening of these provisions to then have clarity around due process having been followed, because we will only expect the commissioner to utilize these powers and appoint agents and so on only when a demand has been raised, has not been responded to, and so on. And I believe, Nixon, you would confirm that point. So just a matter of just tightening this provision a bit more to provide clarity and to ensure that there is no abuse and there is very clear steps that need to be taken prior to these powers being enforced. Now, I know Fred alluded to thresholds. That's a key point. In most DST regimes globally, we've seen thresholds being included purely because sometimes it's counterproductive for multinational businesses to be required to register in Kenya when the quantum of tax they then need to pay is quite small. So in many regimes, there is always a de minimis. Even in, I believe, in Nigeria, in Ethiopia, they do have some de minimis threshold requirements. And I believe it's high time we looked at that to then spare the burden both on the revenue authority side, so that you're not administering SEPT on very small revenues, and also on taxpayers to then encourage them to then scale up their operations in Kenya to get to a point where they can now afford to bear this compliance burden. I just pause there, Michael.
Yeah, thanks, Ken. And you have highlighted quite a good points there. I think, Nixon, those will be coming in as our recommendations in the public participation. But as Ken has mentioned, you have listed more than 15 items that will be subject to SEPT. And quite interestingly, and Friend mentioned this, we have seen digital asset come in again, noting the repeal of digital asset tax and introduction of excise duty on virtual asset transaction. And the clarity we want to obtain from you, Nixon, is it that now digital asset will now be subject to SEPT? If then these new regulations become, yeah.
I think when we look at SEPT, we go back to the basics. We are looking at charging services that are offered or delivered through the internet, electronic, or through a digital marketplace. And when you come to the specific provision that deals with digital assets, it starts by looking at facilitation of payments. Mention digital assets. So basically what we are looking at is not the owner of the assets or the trader, but we're looking at the service that facilitates the transfer or the exchange of those services. I think that is what the regulations are trying to highlight, but we are very much ready to see your proposals, to onboard them, and also to see how we can make that provision to be much clearer, much better, and non-ambiguous. But basically what the draft means is the services that facilitate the exchange or the transfer of digital assets. And you've rightly mentioned, Michael, that for excise duty that was introduced in the Finance Act, it also deals with the exchange of the same services, akin to how banks are charged on excise duty. Thank you.
Yeah, thank you, Nixon. I know Fred is nodding. He'll be making submissions on that as well. But we know that Kenya does not operate in isolation, and we have to appreciate that we have signed various double tax treaties. And Fred, this one I'm posing to you. In your view, what are the risks in the intersectional relation between the double tax treaties that Kenya has entered into with other countries with the SEPT regime? And what do we need to do to ensure that there is legal clarity and minimize risk of double taxation? Fred, you can unmute yourself.
Sorry, I was speaking on mute. Sorry, I was nodding because my good friend Nixon of the response is giving on excess duty, which I do agree with. I think the issue on digital asset tax is just, as I said, it's more of a policy issue, and also looking at this particular sector being a very young sector that we need probably to encourage a bit as we go along. But I do agree with you, Nixon, 100% in terms of saying one of them is indirect tax and the other one is direct tax, just the way we do for banks here in Kenya. Now, on to your question, Michael, in terms of the double tax agreements, you'll agree with me that most of the double tax agreements are actually all of them are based on either the UN model or the OECD model. When you look at the two models, you'd actually notice that maybe there is no an explicit article that deals with this kind of tax that you're talking about, that is SEPT and taxation of digital economy generally. So as a result, then, and we have some precedences that have been set up by the court, especially for some of the DTAs that do not have management or professional fees, like the one for Kenya and South Africa, Kenya and UAE. And I think the precedent that has been there is that to the extent that there's no a specific article addressing the income that you're looking at in the double tax agreement, then we go back to the article of business profits. And the question we ask ourselves there is whether the entity has a permanent establishment in Kenya or not. And if the answer is no, then it would be arguable, it would be correct to say that then that non-resident person is not subject to tax in Kenya. And by extension, what that means is then if, for example, you are providing services from the UAE, the DTA between Kenya and UAE does not have a particular article, so you will not be taxed in Kenya to the extent that you don't have a permanent establishment in Kenya. The only rider to put there, Michael, is on we need to also look at the limitation of benefit clauses that are in domestic laws. We also have to ensure that it is not just you being invoiced by an entity in Dubai, but you also got to check the limitation of benefit clause, which provides that you are either listed, and if you are not listed, then 50% shareholding must be in relation to a beneficial owner who is a resident of that other contracted state, in this case, Dubai. Michael?
Yeah, and maybe if I may jump in, just to add on to that, what we've seen in other similar regimes, so DST/SEPT regimes, in their rules, they've then had provisions which then talk about treaty primacy. Yeah, to then ensure that there is clarity on DTAs overriding the SEPT regime, right? Because otherwise it will be, Kenya will be unilaterally going against its DTAs when it then imposes SEPT on jurisdictions which have signed a DTA with Kenya, right? So we've seen this in, I think the Colombian regime has specific rules in its SEPT/DST regime, which then provides that the DT has primacy. The same position appears to be in India and in Pakistan. So there's lots of best practice that we can borrow in terms of ensuring clarity in our regulations, now that we have the opportunity to provide that DTAs apply. And in any event, we do have all these anti-avoidance measures anyway to avoid treaty shopping and so on. And therefore, there's sufficient safeguards in any event for the Commission on that issue.
Yeah, thanks, Ken and Fred. And you have mentioned best practices that we can borrow from Ken. I don't know if you have something to add, looking at the global trends in line with the OECD, BEPS, Pillar 1 framework. Is there any other international best practice that Kenya can borrow from when implementing the SEPT regime?
I think in addition to to this DTA point, the other issue, and of course we've discussed this briefly, is around thresholds. These taxes are designed to apply to MNEs, and therefore, which are expected to then have significant revenues, and therefore having thresholds appears to be part of international best practice. And there are quantums that have been used depending on the economies and so to then ensure that this tax then is being applicable to the people who it is intended to apply to, and at the same time does not stifle innovation and foreign businesses who are keen to come and start working in Kenya without necessarily going through that burden until they scale up their revenues and so on. So I'd say those 2 points around DTA primacy and revenue threshold are part of what we can borrow from an international best practice perspective. But also when it comes to these enforcement measures, again, what we've seen in other regimes that we've looked at is there are sufficient safeguards, which then provides checks and balances prior to the commissioner then exercising powers to then appoint local agents and so on and so forth.
Yeah, thanks, Ken, and a good point you have noted there. But I'll go back to Nixon, and I know you implemented DST, VAT on DMPS as well. And what you are saying is monitoring cross-border digital transaction remains a challenge in Kenya. Therefore, what mechanisms is the Revenue Authority implementing to improve visibility and compliance? You can mention borrowing from the learning points when you implemented DST and VAT on digital marketplace applies.
Thank you, Michael. And I'm hearing very good proposals already coming in, and we will use them again to refine and make these regulations much better. So with respect to monitoring, and allow me to connect it to thresholds. One of the arguments that came prior to the amendment of the 5 million was the fact that monitoring and enforcing this tax regime is not as easy as our residents. And therefore, if you have a threshold, then you add another layer of complexity in terms of monitoring and enforcement. But I don't know, maybe Parliament discussed that and saw it better to remove the threshold. And I hope Fred is not introducing a threshold through the regulations. Maybe it's something we will do then in the Finance Act. There are 3 ways of monitoring and enforcing compliance in this regime. And these have been used in other jurisdictions. We are also making use of these measures locally. One is what we've seen in Section 42, which Ken had mentioned, and then Fred, that maybe we need to highlight more, avoid ambiguity. But what Section 42 in the Tax Procedures Act basically starts by saying where somebody has not. So the commissioner doesn't just wake up and appoint an agent. Then the commissioner must satisfy certain threshold, certain qualification mechanism that indeed ABC has not complied, and therefore then we go into the process of using agency model to collect the revenue. In fact, when you look at that section, it further says that the taxpayer has to be informed that the KRA has taken the agency model because of reasons A, B, and C. So agency model is one of the ways of implementing monitoring and enforcement, especially where there is no compliance. Number 2, currently there's a lot of collaboration between countries. Kenya is a signatory to the multilateral Convention on Assistance and Collection of Taxes, and also in exchange of information. So that becomes a very critical avenue to monitor and enforce even collection of taxes. Remember, in the last Finance Act, we also introduced the provision that Kenya can now collect on behalf of another country, and therefore another country who is a signatory to the can also collect tax on behalf of Kenya and remit that to the government. And then what we've been doing in the space, because we are happy that majority of the companies are largely compliant, is to facilitate them. I think this is one of those regimes that you have to be very assistive, you have to be facilitative, and then compliance then kicks in. And then we know the big companies generally want to comply once they know exactly what they're supposed to do. But the 2 mechanisms is what we use. We could then appoint either a bank or a payment service provider. We could appoint a customer of the non-resident or even a related party to the non-resident for purposes of enforcement. And then one last comment, Michael, is on the issue of limitation of benefits and the DTA. I think this is a very important area to pick on. Yes, the DTA might limit SEPT application, because of the Article 7 and in the absence of Article 14, even if Article 14 is there, then the income is already subject to Article 7 business profit mechanics, then the SEPT will not apply. However, our own section 41, 42 kicks in terms of the limitation of benefits, looking at the shareholders of the company in the country in which we have a treaty with, then SEPT might or might not apply. But I'm happy with the comments, Ken, that we could have some more information how SEPT then interacts with the DTS in the regulation, so that it's very much guiding. And we are happy to onboard such and discuss to make our regulations better.
Yeah, thanks, Nixon, and panelists, allow us to take one or two questions from the audience. Derek, if you may, I know you've been tracking the questions.
Thank you, gentlemen, for that rich conversation. We have a few questions on the chat, and I would ask the audience to give us maybe 5 minutes to be able to cover these. I know we're almost coming to the end of this session. So the first question, must all the boxes be ticked, such as protocol, terminal, physical address, and payment in determining if a customer is in Kenya? What if the services are accessed from Kenya, but there is no payment made? I think I can pose the questions and then we can take all of them in one go. And then we have a question from John Kariuki asking, what happens when the resident person uses a credit card issued by a non-resident bank? If you registered, this is another question from Stephen. If you registered for SEPT and there are payments you are making to digital content creators, then you are required to withhold tax. How is your experience on administration of the same? For companies, it is proving to be an administrative burden. And then we have a clarification being sought specifically to clarify the difference between resident, non-resident, and non-resident with permanent establishment. I think we can clarify that. And then lastly, does SEPT interact with the minimum top-up tax provisions? I think we can take those and then we can pause it there. Michael?
Yeah, thanks, Derek. Fred, I'll ask you to take the first two on the question whether all boxes need to be ticked, and the question around a credit card issued by a non-resident bank that is used to make payment.
Thank you, Michael. Those two questions are actually related. And if you look at paragraph 5 of the regulations, the language that is actually used there is that if you meet any of the following parameters, you don't have to meet the 4 parameters. To the extent that you have met one of the parameters, then it is deemed that the income is derived or accrued from Kenya. And of course, the second one, in terms of using a credit card for a non-resident bank, to the extent that then you meet any of the other parameters, you'd still make that income to be deemed or derived from Kenya. Thanks, Michael.
Yeah, thanks, Fred. Ken, the next one, I'll bring it to you. They want the clarity on resident, non-resident, and the non-resident with a P. And as you take that as well, maybe you can also take the last one in terms of whether there's interplay between the minimum top-up tax and now the SEPT tax as well.
Thanks, Michael. So when you look at resident, so resident will be a Kenyan resident company, so incorporated in Kenya. You may have a non-resident who has a branch in Kenya. So in that case, they have a permanent establishment in Kenya. In which case, of course, SEPT does not apply because then the Kenyan PE is being taxed. And then you have the non-resident. The non-resident who does not have a Kenyan PE, that's, those are the entities which will be fully subject to SEPT. Yeah, so just really that's a distinction those in terms of those 3 categories. Then the next one, Michael, was it around the interaction
minimum top-up tax, yes. There's one around minimum top-up tax and the interplay with SEPT.
Yeah, look, I don't see how that will be interacting. Yeah, that's probably something that I'd probably ask Nixon to opine on, but certainly not from a Kenyan tax perspective, because the minimum top-up tax will then ought to be payable in the jurisdictions where the MNEs will be resident. So it may end up being an issue of interpretation from that domestic tax position, but ultimately, SEPT is an income tax, so it will be treated in the same way from the perspective of the MNE as any other corporate tax that has been paid in overseas subsidiaries. But I don't think there's anything specific which deals with how SEPT is supposed to interact broadly from a minimum top-up tax perspective. Unless you have any points on that.
Nixon, I'll open it up to you, and as you comment on that as well, you can comment. And I know this can be cured through the regulations, the complexity that has been highlighted when you are paying digital content creators and you expected withholding tax, and now the introduction of SEPT as well.
Okay, let me start with the SEPT and the DMTT, and I agree with Ken. From a Kenyan perspective, because Kenya is only implementing the top-up tax, what in other international language we call the qualifying domestic minimum tax. And when you look at the Income Tax Act, it's a tax on any person with a PE in Kenya or a resident. And so, and SEPT is actually ring-fenced to non-residents, and therefore, from a perspective, there's no interaction between the two. Maybe there will be some interaction when you look at the other facets of the global minimum tax, which is the income inclusion rule and also the under-taxed profits rule, where then all these taxes needs to be taken into account from an ultimate parent entity perspective, looking at the countries in which each of these companies operate. But from a Kenyan perspective, no interaction. But if there's anything, again, Fred, Michael, or Ken, we would be glad to see it. I know the draft regulations on the top-up tax will be out in a few weeks, and then we can also discuss the same, if there's any interlink between SEPT and the DMTT. But from my standpoint, I don't think there is any. SEPT and withholding tax, also very different, of course, accounted for by the same person. And I hear you when you say it also brings administrative burden, definitely, because you have to pay the SEPT on your income. And then you also have to withhold on content monetization, or when you are facilitating any payment to somebody who has earned income in your platform or digital platform, then of course the burden is on you. However, the tax definitely is on the income of the resident content creator. So administrative burden, yes, you have an additional tax to account for, but economically that tax should belong to the Kenyan content creator. And I saw a question on how it's going on. I think the progress is wonderful. Compliance is actually doing very well in terms of the companies who are withholding the tax on account of either content creators or facilitating payment on their digital platforms. But again, as we always say, and I'm happy Fred mentioned this, we want to facilitate anyone who is finding challenges in accounting for either SEPT or withholding tax, so that, of course, we make it as easy as possible. Thank you.
Thank you.
Yeah, thanks. Thank you, Nixon. Allow me to hand it over back to Derek.
So, Michael, before we close, there's one question that I think we should take. And this relates to BPOs. And sincere apologies again, members, we've gone 4 minutes over time. But where do BPOs sit in this SEPT tax conversation? These are entities incorporated in Kenya but work for MNO. So kindly advise on how it works for that.
Yeah, Fred or Ken on that one.
Yeah, sure, I can take that. So BPOs, you did mention that it's an entity that is already incorporated in Kenya. So to that extent, then SEPT is not applicable. Remember, we said SEPT is only applicable for non-resident entities. So unless you have people that is registered outside Kenya, that's when maybe there could be a conversation, but there would be need to look at your services and see whether they actually fall within the category of what is called a digital service. But to the extent they are registered in Kenya, they're good to go. SEPT is not an issue.
Thank you, gentlemen, and thank you for that candid conversation. Michael, thank you so much for expertly moderating this panel. Nixon, Kenneth, Frederick, thank you for sharing your insights and bringing clarity to this conversation. Before we close, I'd like to hand this back to Fred, who's the chair of the AmCham Tax Task Force, to close it for us.
Thank you very much. Again, thanks Ken, thanks Nixon, thanks Michael for this conversation, and thank you very much for the members who were able to join this morning. Thanks for your insightful questions. I'm sure this will form, this will shape the conversation that we have as we get to the drafting or other finalization of these particular regulations. Thank you very much again. So the only point that I would like to mention in the interest of time, that you must have received the communication from AmCham requesting you for your submissions. I think the deadline from an AmCham perspective is on Monday, that is on date 6 by 11th. Please send them as soon as you can. So then AmCham is able to consolidate together in working closely with the task force, and then so that we are able to submit by 7th, that is on Tuesday. And then, of course, there will be other submissions that will happen. But thanks a lot for your continued support. We continue engaging. Thank you very much. And the slides will be shared with you just for your reference. Thank you, Derek.
Fred,
Back to you.
thank you, everyone. We've come to a close of this session, and we will share the recording and the presentation that was made this morning. Have a wonderful day ahead.
Thank you.
Thank you.
Thank you, everyone.